Welcome everybody. This is the Thursday evening Viper trading webinar. If you are here to learn about trading the futures markets using the Viper tools, you're absolutely in the right place. First thing we have to do, of course, is get our standard disclaimer out of the way. And we can get straight away onto some charts and some trades, which of course is the reason everybody's here tonight. All communications from Viper Trading Systems are for educational purposes only. Futures and Forex trading does involve risk, and there is a risk of loss. Nothing contained in this webinar, other webinars, including the live trading room, are to be construed as investment or trading advice. And of course, everybody in here does know that you do trade at your own sole discretion. All right, good. I'm going to change the topic a little bit. I think today's topic was something to the effect of fade those swings for great trade entries. I'm going to, since we had such a radical, volatile day, I'm going to, in the first part of the webinar, cover some of the setups that worked this morning. And then we're going to take that knowledge and leverage it into other charts where we're going to look at trades together, and then as a team we'll make some calls on what you see to prepare ourselves for tomorrow. Okay, so without further ado, let's get over to a NASDAQ chart, and that would be located on screen 1. All right. Most of you, almost everybody in here has been with us for some time, so I'm not going to spend a lot of time going through the basics. I'm just going to more or less assume that you know pretty much what's going on here in terms of trend direction, background color, bar colors, the mid-band and how to use it and all those kinds of things. I'm going to talk a little bit more about some more advanced topics tonight. Targets and trailing stops, and how to really approach markets when they're really moving like this. So here you can see that right at the open, we got a very nice sell-off that occurred on YM. All the equities and crude sold off early. This is 6:30 Pacific, so this is the open of the market right here. You can see that before the market opened, we had already started to turn down with this thrusting move to the downside here. Excuse me, background color changes. Bars are red, stair-stepping down on the bands. Right at the open here, we get a very nice retracement set up right up into the mid-band right here, and we rolled perfectly. I know some of you probably took that. We called it out live in the room. Rolled over, textbook entry here on all sorts of different ways to use your tools from Object Trader to get in. You could have boxed it in up here. You could have used your line or ray tool. You could put a sniper line up here. All manner of ways to get in. Anyway, but you were short. Now, the reason, and we've covered this before, I'll just cover what we have spoken about before in terms of targets and trailing stops. When you get into a trending move like this, there's a couple of different ways to approach it. The first way is, and most of you might do this, let me get some of these arrows, move them out of the way a little bit here, is if you're using OT, it automatically places your stop, depending on your setting, 10 to 12 ticks above your entry. So if you were filled short on this bar right here, one of these bars short, right in here, let's go back up 12 ticks. Let's see on NASDAQ, 3 points, 95. So, your initial stop would have been somewhere probably right above that swing right there. This would have been your initial stop on your trade entry. Now, if you're trading multiples, you have several choices. We've talked about this before. You can, let's say you had 2 or 3 on and you wanted to take some profits on your first contract when it bips down here, say 5 or 6 ticks, 8 ticks, maybe 10 ticks. So you're out of one of them, and you set your Object Trader trail setup to engage after that first contract comes off, say at 6 ticks to 2 ticks behind your entry. And so the trail then kicks in and drops you down to here. We've discussed that many, many times in several other webinars, so I'm not going to get into the mechanics of how that works. We all understand conceptually what's happening here. Now, in terms of the remaining contracts on your multiples, you have several choices. You can, let me get this arrow, move it over here. In fact, let me just take that arrow right off for now. There. All right. Now, the more aggressive trailing stop posture is to trail the market down very, somewhat fairly close to the swings in the price, and you kind of follow this line down here in between the stealth line, which is here. Let me put this right here. See the stealth line, the smoother curved line, and then this upper band just above the line, just above that final band, outer band. So when you're in the live room and you hear calls of different stop levels, that's what I'm observing. I'm observing that if you are a trader who likes to bank profits quickly and keep tight stops, and then looks to re-enter on retracements, then that's what the tight stop is. The tight stop is intended for you to get out of the trade when it starts to bounce, in which case it probably would have taken you out of the short, this first short trade here on this candle right here, somewhere in there. So now that you're out, you're looking for re-entry. So now we're looking for retracement, and of course you see it comes right back up into the mid band here and rolls, giving you another short entry right up in here, which I'm sure we called in the room along with the other trades that we're setting up at this time. And so you re-enter. Now, and then we drop down, and the process repeats itself again, on down, on down, on down, and we have several other trades that do the same. Now, with the tight stop trader, quite possibly might have got stopped out in this little choppy BIP program right here, or even perhaps this little BIP up right here, depending on how tight your stops were. If you trailed them just like the other one, you could have gotten out there and then gotten back in on the rollover. So what you're doing then is you're getting in, you're banking profit, and you're getting out, and you're getting back in, you're banking profit, you're getting back in, right? You're dropping, trailing your stop, getting out. Now, the other approach is to make this trade one continuous long trade, or not long, one continuous short trade. So the initial entry is the same up here, right here. The initial entry is still the same. It's no different. And all the other entries are the same if you're stopped out. However, in this secondary approach, the stops are much looser. The stops stay above the swings and generally somewhere at or above the mid band. Now, the advantage of the longer approach is that you trade less. So obviously you have less commission to deal with because you're not getting in and out, in and out, in and out. The downside of that is that you can see that these retracements are fairly beefy. So when I say that, I mean, let me explain what I mean by that, in the fact that, here's the trader who got out here at, say, 85 3/4, 86-ish, and the apex of the trade was down here at 83. So this trader has already given back 9 ticks on a retracement off the apex of the sell-off there in terms of the drawdown at the end of your trade, right? Whereas the runner trader gives back all the way up here to 90. So from this perspective here, from 86 to 94, that's another 16 ticks. It's not unusual on a running trade with these retracements to allow as much as 20 ticks on a retracement. That's not unusual, particularly if a market's running 60, 80, 100 ticks. You're going to give up 20 ticks on these retracements. That's what it's going to do. So you have to develop your own personal style. If you like to get in and out, you like to bank the coin when you have it, you don't like to give back 20 ticks on these retracements, well, then you're the first type of trader where you're getting in and you're getting out. You're getting in, you're getting out, back in, out, etc., all the way down, right? And you can do a little bit of both. The other approach is one that Gary uses, and he's described this in his webinar and he talks about it in the live room, is you take the initial short up here, and then you bank your coin as it drops, and then you add to your short position when it rolls up here. So you're not completely ever really getting out until your full stop out at the end of the trade. he's adding. And so what happens is that dollar cost averages the short down. So the initial entry was here. You add more contracts here, and the blended average is somewhere in the middle. So then think of it this way. You're sort of getting in, and then you're taking profits, and then you're adding in, dollar cost averaging, blending. Stupid thing is not working. Hold on. Right? Are you following me? Adding in, it dollar cost the short average down. It comes down, it drops. You bank some profit. It comes up. You add to it, and then you bank the profits. You add to it, and you bank the profits. And so in that sense, you're kind of blending the two approaches in the fact that you're banking the coin on the way down, and you're leveraging the fact that you got this sort of this ongoing short that winds up dropping, I think over 130 ticks at the final piece of it here. By the way, just a quick poll of the team here tonight. And by the way, if you're coming in late, this is recorded. We will put it up on the web. It'll be in the subscriber area and on the YouTube channel, as well as our web page for accessible for everybody, either tonight or tomorrow morning. And so you can watch it again, or if you have to leave early, you can catch the tail end of it on the recording. So, I mean, this could have been, back to my question. So just a quick poll of the team. In the two types of trading styles, which type is everybody in here tonight? Which type of trader are you? Are you the get in, get out trader, or the long-term, let it retrace trader? For the get in, get out approach, you could just type in GGO if you want, get in, get out, and then just put in an L for you like the longer runs. Which approaches, or do you like some blended adding? Put in add if you like to add. Do you like to add it like Gary does? Oh, we got a mix here. Okay, wow, interesting. Okay, Jim likes the tight stops. David D's an in and out trader. Kim likes Gary's style. Okay, that's probably the in and out approach. Walter likes in and out. So does Jim, in and out, in and out. Banker from Dave. Long-term trade, Charles D. Okay, interesting. Depends on what the market is offering. That's a good comment, Dennis. Yeah, get in, get out from Jim. I get in, get out a lot from Peter, but I want to do the longer trades. Well, that's an approach that takes a little bit of work, and you know as well as we all do that you don't always get huge runs like this. Okay, so the ability sometimes to do these kinds of things like this don't always present themselves, every morning. Sometimes we're dealing with chop, so we don't get these huge long runs like this where you can get in, get out, take the longer term approach. YM, we had some short covering here, obviously. Profit taking from sell programs. A little buy program kicks in here. I don't know if you recall, it actually started to head up. You got a couple long trades here on retracements that I believe we called, took some little scalps out of it. Interesting, Charles D., who's one of our team members, subscribers, been with us for a while, does monster trades every day. He says, interesting, his comment here, I used to get in and out a lot, but now I've gotten a lot more comfortable with the long-term approach. It is an evolution, Charles D. It is absolutely an evolution, mainly because we're so programmed to take that profit as quickly as possible. And so the notion of giving back 20 ticks in a trade is just sort of unfathomable for a lot of traders. Yeah, absolutely. Yeah, and that is a risk. Peter says sometimes when I go and add at those swing levels, the market then reverses and I get taken out. That is a risk to the adding program. You really have to look at the instrument you're trading and see if that type of approach really works on a consistent basis for whatever instrument you're trading. All right, so yeah, we get this little, a little buy program comes in here after the short covering, kicks the market up a little bit, and then we come over here and we start to reverse. The sell programs are coming back now. We see we get our thrust in the down direction, right? See it? We pop up. We come right back up to the mid band here. I think we probably called this in the room. This was 640. This is not quite 7 o'clock. By the way, this could have been your one and done. Back to this right here. This could have been one and done for you. I mean, with a couple of contracts in it, even if you got in and out, you would have probably made at least over 100 ticks, which is $1,000 on 2 contracts. That for most traders, you probably might have been at or over your goal for the day on this trade alone. You could have been done by 6:45. Less than 15 minutes in the market, and you were up easily over $1,000 and probably done. In fact, that trader, his name's Paul. You probably, those of you that were in the live room, he shorted this call when it came up, or no, he took YM. We'll look at that separately. All right, so then we roll over here. We get our thrust down. We come back up. This is sort of the textbook setup that we look for, where we get the thrust in our resuming downtrend direction. Background color changes. Bars are now red. We come back up just under the mid band. We roll over, giving us the short entry. And then we repeat the process as the sell-off resumes. And this one dropped as much or more. Just a monster trade with 1, 2, 3 trade entry opportunities on retracements. Back up just shy. This one touched the mid-band. This one was just shy of it. Was the green area traded? Dave, yes, it was. Yes, it was. In fact, I don't know if we caught this long, because when it came up here and rolled, we might have still been thinking short, but I do remember calling this and this. So we did have 2 quick long trades in here. I didn't show those here because, you know, the other markets were still heading down, and YM was kind of running in a counter position. I'll show YM in a minute. NASDAQ was clearly the weakest of the bunch and getting hammered the hardest of the 3 equities that we track and trade. So here was another opportunity. Even if you missed all that movement before 6:45, you got another shot to come in here and jump on the shorty bandwagon and ride this puppy down for the next 15 minutes or so. Another sell program, intense sell programs come in, start really selling these markets off. You get a deep retracement here and then another chance to get in, and down you go. If you recall, the Dow opened up. I like to track the Dow. I don't trade it directly. It's a cash market, obviously. But I like, because it gives me a feel, an overall feel for what the market's doing. And so, for instance, and they've been doing this lately, right? The markets will gap up. You know, Dow will open up 70, 80, 90 points. Shorties come right in, take the puppy down. Boom, down she goes. This was a very intense sell-off, more so than we've seen over the past few days. And we continue on down, and we continue on down, and then we get a reversal here where the market then starts to head up shortly after 7 o'clock over here. NASDAQ, not so much. Let me open up the YM chart. You can see very similar movement here. Here's YM. You can see the sell-off on YM was not quite as intense, as they were really hammering the tech stocks today and the tech future market. NASDAQ, here's YM. This is the large caps, the Dow, mini Dow. And we got very similar short setup here. 6:30, come down, we bip up, we hit the mid-band, we roll, giving us the short. We stop out, we get this deep retracement. See how different this looks than this area right here. Let me put a frame of reference around this for you real quick here. And you know, is very characteristic of doing this. And this is the difference between NASDAQ and YM, which can be both good and frustrating at the same time if you trade them both. So this little area right here of retracement on YM between, you know, 640 and 645, this little deal right here, is equal to, on NASDAQ, just to compare the two, this area right here. So Dave, to answer your question, we did not. You had actual couple little scalper long setups here on NASI through here, whereas the same exact area on YM really never got you long, because by the time this came up here and rolled, it went right back into the sell-off. Can you see the difference between those two? And that's something you have to get accustomed to if you're going to trade those two instruments. Going over here, let's look at the run back up. Here we consolidate a little bit in this area here, right shortly after 7 o'clock, where there's a period of somewhat indecision. The markets are trying to decide which way they want to go. We're not really heading up in this box here, and we're really not heading down. We're kind of in a range, just going sideways for about 10 minutes. And then we go into this protracted run back up here. By the way, I don't advocate doing this, particularly in the beginning of your or even mid part of your trading career, where you're getting your sea legs about you, so to speak. But some of you may recall we have a trader, Paul, in our room. He took this call up here, the short off the mid-band, all the way down to here, this quick drop here. I believe he put somewhere around 60 contracts on it and made quite a bit of coin on this short right here, this beautiful short. So that's the other way to do it. Yeah, he was one and done, and I think he mentioned he made, it was either 12 or 15,000 on that short. So that's what you want to do when we talk about leverage and we talk about one and done and picking your spots. That's what it's all about. It's not grubbing around here and trying to grub out a couple of 3-4 ticks with a 12-tick stop and hoping you get, eke out 8 ticks or a couple of 4 or 5 ticks here and there. You can do that. You can scalp, and we have a lot of scalper traders, particularly in these ranges, that do very well doing that. But the moves that put more coin in your pocket are these longer runs, and you work your account up till you can leverage, put much more leverage on there, so that you can nail one or two and you're just absolutely done for the day. Now, this moves so quickly, truth be told, on YM, we missed the first leg or two of this because it just went up so fast and it kind of caught us off guard a little bit right in here. So this initial thrust, we did not take or call. Pulled back here. This was so quick. This was really pumping at the time. I don't know if you remember this, but this thing was ripping. It was ripping back up. Clearly, buy programs have kicked in here and are driving the market back up. We pull back. We get support. You may have caught that if you were quick. If you jumped in with a market order, you could have caught this first or second leg here. We did capitulate a little bit around this 93 area. We did call this, and we did get in here. We did take this one. And this turned out to be just another monster trade. The whole move all the way up was around 240 ticks with several retracements to get in. This was our entry right here. Here again, emphasizing the two different trading styles. Excuse me. Let me take a quick sip of tea here. Hold on a second, please. Trading style number one is the get in, get out approach. You're getting in, you're taking some coin, you have a stop posture protocol that you use here. You get out, you look for retracement, you get back in on the bounce, you stop it, you get out, get back in. The looser or some combination of the two. The other one, of course, is like we showed before. You deploy a looser stop strategy. And if you have multiples on, you're peeling them up on the way. Keep your stops just behind the midband, allowing the retraces to occur, allowing them to occur all the way up, and then you're taken out finally up here. Just a prototypical day of thrust and retracement on both on the downtrend side up to 7, and then shortly after 7 o'clock Pacific, then of course this beautiful run back up, which from top to bottom I think was somewhere around 240 ticks. So as you recall, what did the Dow end up? Anybody know? I think it was over 200 points, wasn't it? What was the final tally on the Dow there when she was all said and done? Anybody remember? Uh, 227. Yeah, there you go. 227. You're right, Dave. Yeah, she ended up 227 on a day. So I mean, just a you know, and that's reflective of the futures market here too. I mean, you had the monster sell-off right at the open. 729 is the entry here, Kim. Yeah. You may not be quite as familiar with our entry technique here, where we look for in an uptrend, we buy retracements into support at or near the midband, which is precisely what you got right in here. We use our tools to get in. If you used a region box, it probably looked something like this. You can use the ray or the line tools, which would look something like this. Entry on both of those would have been long this bar right here. 12 ticks below would be your initial stop down here. And then you can scalp, you can take some scalper coin as she pops up here. And then for the tighter trader who likes the tighter stops, this might have taken you out, but you could have got back in on that bar right there, depending on how tight your stops were, or even this one right here. That's what you got to be careful. You got to really watch your stops, how tight they are, because you can get in and you wind up getting in and out a lot, right? Here's another entry right here. Tighter stop trader would have been perhaps taken out on that bar right there, trailing the stop and jump back in on a roll back up. So, you know, and when it's really moving very precipitously and quickly like this, you can see that the get in and get out approach isn't necessarily really helping you per se. Take this trade right here, for instance, on this yellow bar retracement just above the midband. You know, if you had gotten out with a tight stop, you know, it's quite possible it dinged you out on this bar right here, right? Well, then after it bounced and you box it in, you're getting back in on this bar right here, right? You box it in, you sit there, and it takes it, and now boom, you're right back in it. So have you really gained anything by getting out? Sometimes in strong runs like this, not necessarily gaining anything by getting in and getting out. It really is a function of the depth of the retracement, right? If you're getting very deep retraces that are coming deep down below the midband here like this, hypothetically, if this had come down here like this, well then, yeah, you know, you're better off getting out of it up here and then re-entering because you got an advantage and you're getting in at a better level. 729. This is another entry right here, Kim. Yes. All of these retracements down into support levels are potential entry points for you. Yes, absolutely. We are in trending markets, we are what you call retracement traders. There's one right there. There's another one right here. There's a real lag in this thing tonight. I don't know why it's lagging so much. There's another one right there. Each of the retracements is potential trade entries in the long uptrend direction. All right, okay, so here's what we're going to do. I'm going to pull up some other charts. We looked at NASI, we looked at YM. What do we want to see? I've got two other charts we can get up here before we run out of time. We can look at the Russell and crude oil. Which one do you want to look at next? Let's take a poll of the group here, the team. What do you say? Roosty Bird TF or CL, your good old friend crude oil? What do you want to see? Taking some votes. A couple of TFs, a couple of CLs. Dow charts? Oh, I don't really look at Dow charts per se, Dennis. I just, you know, it's really simple. Here's what I do. It's really this simple. I have a little ticker of the Yahoo Finance up right here. Now, when the markets are open and active, in the tab here, it will show the Dow and it'll show it how much it's up and down right here. Okay, and so what I do is I take it on my screen and I tuck it down here like this, and I look at that tab as it updates, and I get a feel. I sort of glance as I'm trading. I sort of glance down and I'll look at it, and I use it as sort of a reference point. I see if it's every time I sort of glance at it, it's going up. It's up 17, and then it's up 37, then it's up 63, and then it's up 90, 100, 120, and I see that the markets we're trading, the equity markets, are heading up. It's just another thing that sort of confirms the uptrend of the equity markets. On the other hand, like today, for instance, I saw it open and it was up 90, and then all of a sudden it started crashing. It was only up 60, and then 20, and then 30, and then 20, and then it turned negative. Right here, like this. See, Yahoo Finance. And you click on the Dow tab, like this. See it now? You don't have to do that. I mean, you can put it on the screen, or you can just listen, or you can, like CNBC has a ticker, a ticker. You can glance at the ticker, or however you want, or you don't even have to use it to get a feel for it. It's just something I do. See how it's up here? See how it's on the tab? And I'll just tuck it down here like this, so I don't have to look at the whole screen. I'll just have a little tab like that, and I'll just sort of glance at it, get a feel for what the Dow's doing. It's like anything. If it helps you, then use it. If it doesn't help you, then don't bother putting it up, obviously. All right, so here we are with the Russell, and between 10:30 and about 11:30, was the Russell trending, yes or no? 10 seconds on the clock. A Y or an N, you got 10 seconds. Between here and here, was the Russell trending, yes or no? From here to here. 5 seconds. Y or an N. Some of you may find this to be a quasi trick question. So I'm testing you. Time's almost up. 2 seconds. From 10:30 to 11:30 approximately on the Russell, from here to here, was it trending, yes or no? Time's up. Interesting. We got a real mix of yeses and nos. We got predominantly, I'd say 2/3 of the team here tonight saying no. However, we're sprinkled with some yeses. Now, that was somewhat of a trick question in the fact that the background was red. We had red bars. We were quasi stair-stepping down, and you were borderline trending down, but in a very choppy sideways manner. So those of you that said yes or no, technically it was doing a little bit of both, right? And markets do this sometimes, particularly the Russell. Same with oil. Oil can do that sometimes too. Yeah, so it was sort of trending. It was sort of trending a little bit to the downside, but in a very, you can make the case also it's very sideways in a very sort of choppy manner. Now, if you're going to trade this, if you were to trade this, would your primary mode of entry be to buy support and take profits at the top of the range? Or would you be shorting the top of the range and taking profits at the bottom? So if you're buying the bottom and getting long, to go ahead and type in an L. If you're shorting the top here, type in an S. 10 seconds. What is your primary mode of entry when a market looks like this? S, shorting the top. L, buying the bottom. What say you, team? 5 seconds left. What are you doing to get in? I know some of you might not even trade that. Maybe you don't like ranges, but if you did, would you be shorting the top, S, or L, long, buying the bottom? 2 seconds. All right, time's up. Sorry, Kim. For those of you who are visiting, some of you might still be on a free trial and visiting and what have you, and learning a little bit of the terminology and what you're looking at here. So if I'll explain it in 1 second. Shorting. We're shorting the top. So when you notice that the background is red and the bars are red, and you're gently sort of stair-stepping down, even though you're sideways, we're still kind of in a somewhat of a downtrending move. So what we do is we short the market when it comes up here into the resistance area. We're getting short. That's our primary mode of entry, and we're covering at the bottom of the range. So that was the question, Kim. When you're in a range like this, you have three approaches to trading a range, right? You can short the top, profits at the bottom to cover. You can buy the bottom, take profits at the top because you're getting long. Or you can trade both sides, shorting the top, buying the bottom, shorting the top, buying the bottom, shorting the top, buying the bottom. Generally, you would do the both approach if the market looked more like this, where it was just completely flat sideways. It was at least 20 to 25 ticks or more in size, and the top and the bottom of the market was very well defined. In a situation like this, where the direction is not clear and it's maybe 20, 25, 30 ticks in size, and the top and bottom has very nice, clearly defined support and resistance, then we're buying and selling. Okay? Good. Let me pop a couple more up here for you on a quiz, and then we'll go over and look at crude. Let's look at some mid-morning trades, because we all know what happened in the early part of the session. We all know that. Let me clean this chart up a little bit here and ask you a couple of questions. Stand by. Yeah, you know what? The Russell was a little choppier, wasn't it? Yeah, wow. Look at that. Russell did somewhat similar to the other two, but then after about 7:45, she got real choppy, didn't she? Yeah, let me show this before we get more questions up on the table here. Let's go back and look. So here's the Russell at 6:30, more or less following the other markets. Here we get our market open at 6:30 Pacific right here on the Russell. And notice we didn't immediately go into. As I recall, Gary was a little frustrated with this when he was trying to take trades here. I remember this. The other two markets were tanking, and for about 4 or 5 minutes, the Russell just kind of sat here. See this? Remember? Was anybody trading this? Anybody in here trading Russell? Do you remember that? Remember how frustrating that was? It had to follow the other markets at some point. Russell sometimes is a little, well, they all can be like that, but a little obtuse, if you will, kind of, just sitting there where the other ones have dropped already, 60 ticks already. Charles D and Walter were trading that. Yeah, so you remember that, huh? Yeah, that was a little odd. But then she broke down. You got the nice short here. Right there. Came back up, chopped around the mid-band a little bit. Of course, you break down, get the next short leg for the short. Coming down off of this consolidation patch here. I'm sure Gary shorted this. I'm not sure where he got in. You ride that second leg down. Now, the Russell, particularly today, if you recall the other charts where you got those nice retracements up to the mid-band, you didn't really get that on the Russell. I mean, when she dropped, she stayed on almost pretty much under the stealth line here until right here. And then you went into these big sort of swings up and down. You ran up and then all the way back down and then all the way back up, and you just kind of chopped around a little bit here with these big swings trying to figure out what to do. And then eventually around 7:15 or so, she started to flip and head back up. And I don't know if Gary caught this first leg. I don't remember all the trades because I was trading too, paying attention to my own charts. But I don't know if he caught that first leg. Do you recall, Charles D. Walter? You were trading this with him. We missed that. He missed that first leg, just like I missed YM and Nasdaq. But then I think he caught this retracement back into the mid band right here. Did he? I think you guys got this right. Is this where you got in? Yeah. Okay, you got back in here, and he caught that right. Yeah, and he caught that next big leg up right here. Well, which is nothing to sneeze at. I mean, that second leg alone right here looks to be about well, depending on where you got in and out. Excuse me, say 09 up here to 16. 70 ticks. That's still a nice trade. Yeah, awesome. Just totally awesome trades. All right, let me pop. I'm going to do one more Russell setup, and then we'll go over to crude. Okay, you ready? We'll go 20 seconds on this one. All right, now we're at about 8 o'clock, slightly after 8 o'clock in the morning on the Russell still. We've run up. We've had some deep retraces. We've poked up to what appears to be sort of a double or triple top up here. The markets come down. We get a little bit of capitulation around the mid-band here. We get a thrust down, pull back up slightly, and we get another thrust down into this 1080 swing. If and when the Russell was to retrace off of this thrust move, where might it go to? You can type in any manner of response, but we're looking for a retracement. Where might it go to if and when it retraces off of this thrust move down into support here, just under the 1011 mark? We'll give you 20 seconds. $15 seconds. Where might it go to? I'm really going to be paying attention to your answers too, because in every single webinar I go through this, right? Most of you, almost all of you here come to all the webinars I do. I go through this every time. Just checking to see if everybody's paying attention. If you're new or visiting, don't worry about it. We'll show you how it works. Don't worry about it. You might not have an answer because you're still kind of picking up how this works. 9 seconds left. If it retraces, where might it come to? And of course, the background's red, stair stepping down, we're looking for shorts. That's the obvious. I'm not going to state the obvious. We're looking for shorts. Excuse me. Oh, drink some espresso, coffee. Okay, 5 seconds. Come on. What are you going to do? What are you going to do when they come for you, Nazaru? 2 seconds. You're going to short this puppy. Where are you going to do it? All right, time's up. Got some good answers coming back up here. David D says mid-band. Charles D, 1440. Ooh, I like Peter's answer. Anywhere between 1012 and 1013. So he has a range. Good. Get the gold star. Same with Walter. Anywhere between 1013 and 14. Good for you. It's pointing out that you're looking for an area, not a number. That was a trick question. Some of you are okay. I see some ranges out of Chris and Rob S. and some more mid-band calls. And Joseph K. got a range in there too. Good. All right. Just going to very quickly cover this topic, and then we got to get over to crude before we run out of time. We have to think of these areas of retracement as an area, not a number. That's why this was a trick question, because we understand that markets can do 2 or 3 different things as they retrace. I'll very quickly show this. Most of you already know it. It can do a very shallow retrace where it only goes up maybe that far and rolls over and breaks down, right? That would have been in the 1250, 13 area. It can come up to the mid-band, and we certainly love those trades, mid-band trades here at 1320. anywhere in that area right there, and a roll, and we get short. That's sort of the mid-band approach. And they can come deeper. They can go deeper. That's called a deep retrace, where it goes above the mid-band, all the way up perhaps into the 14 area, like this. The healthy approach to, hey Venkata, no problem. Don't worry about it. We recorded this. The recording will be up tomorrow. Yeah, so you'll get to see the whole thing. No problem. Yeah, so here's what I'm doing. Here's what I'm doing. As these markets are moving around, my eyes are scanning between a couple of different things. I'm looking back at swing levels. I'm looking at support resistance levels. I'm looking. Sometimes I'll have a lot of times I'll have the predictor on. You can turn it on. It looks like that, which puts the ovals, the discs, the targets, and swing levels in. Take those off if you think it's too busy. It's up to you. Yeah, and then I'm also looking, and I'm thinking ahead. This is the looking beyond the right edge of the chart. We're thinking beyond the right edge because we have to be cognizant of what has happened back here. That's the swing levels we talk about, right? And we have to be attuned to what's happening in the real-time world, which is what the market's doing right here, whether we're in a trade or not. And then we have to think beyond what the market is currently doing, projecting out into the future and running hypothetical little scenarios in our mind, constantly saying to ourselves, if this market, I'm not in this short, I missed this for some reason, I didn't get in this, whatever, and now I'm saying to myself, now I've got to look for a retracement on where I'm going to go ahead and get in short. And I realized that could happen at three different levels: a very shallow retracement and could roll up around the mid-band here and roll, or perhaps as deep as this 1440. And we have to be prepared for all three scenarios. So when you're rolling those thoughts through your head, I can see here by the responses that several of you are already thinking in that manner, where you look at the retracement as an area, not a number. Okay, good. All right, well, let's see what happens. Let's play this out. Okay, so we're dropping, we're dropping, we're dropping. We hit that swing. We bounce. We're bouncing. Okay, what's happening right now? What's happening right now? Right now on the chart as I'm advancing it. Let me advance. Let me blow up the bars and go a little more. What's it doing right there? Okay, you want some more? How about now? Yeah. Okay, Walter. Yeah, we'll see you in the morning, buddy. Some folks have to take off here. No problem. We're almost done. We got a little bit more. We'll try to catch a crude oil trade or two. All right, so what happened here? Yeah, let's talk about the entry, because this might be confusing. Some people, some of you might be confused about what we're talking about here, okay? And, Gary uses the lightning. I don't have the lightning on here. You can use the lightning. You have a very clear sort of ABC pattern here. We come up, we get A, we get B, we get C. We come up, we hit the mid-band. So let me ask a question. And Kim, let's see if you can get this. Where is the entry? I'm going to show you three bars. Bar 1 is this one right here. Bar 2 is this one right here. Bar 3 is this one right here. You type in a number. 1, 2, the doji, or 3. 7 seconds. 1, 2, or 3. What is the entry bar on the short trade off the mid-band? Let me give you a tip. This is a trick question. There could be multiple answers. 3 seconds left. 1, 2, the doji, or 3. Just type in a number, whatever entry bar you think this is. Now, there's a number of different approaches to get in this. Okay, the predominantly answer is 3, although it's sprinkled with a few 2s and a couple of 1s. Okay, let me really get detailed about this, because I think this is the crux of a lot of confusion for many traders. And if you find this a little confusing, don't worry about it. It happens all the time. It's one of the it's part of a challenging part of learning to trade is where to get in these retracements. So let me be clear about it. There are several different approaches to get in. In the Object Trader tool, you have we have a line, we have a ray. The ray is in OT. The line's a separate tool. We have the region box. This is the good. And we have bar reversal. Okay, bar reversal. Technically speaking, and depending on how this actually played out, you could make the case that this bar here, which I didn't put into the question, could have been a reversal bar and might have gotten you in, depending on how you deployed the tool. Clearly, this doji went just above the midband and reversed and closed just slightly under the midband. This is bar number 2. First of all, we can roll out bar number 1 because bar number 1 did not reverse. So we're looking for, basically, here's a good way to think about these retracements. It is really what it comes down to, is you're looking for some consolidation, some capitulation. You want the market, ideally, in these retracement areas to pause for a couple of 3-4 bars to let you observe it retracing and then let you deploy the tools to get in. If you didn't use bar reversal or a sniper line here, which would have got it when it came and rolled over, you could have put a region box around this area right here as it consolidated like that. So when you hear something in the live room to the effect of put a box around that, it's right at the midband, that's what that means. Take a region box from your Object Trader tool here on the sidebar, engulf the bars, and then the other thing, the final component, is bias to the downside, meaning that the trend is down, so you only want to get filled short. So you'd be filled short on this bar right here, on bar number 3, which by hook or by crook, depending, no matter how you define this consolidation area, that was a reversal bar and closed outside of the region. So you're very definitely short on bar 3. Everybody see that? So what would really help everybody here is to really sort of memorize these patterns like this, and then practice with your tools getting in and out of these trades right in here. And the reason you want to bias to the downside in a downtrend is at the time this is happening, we don't know if it's going to go up higher like this into this deeper retracement area. Let's look at one that did that. And you don't want to get long in a downtrend because you get sucked in and then you get into a bad trade and you wind up. Now here's a case where you went higher. See this one right here? And NASDAQ and the Russell are notorious for doing this. See it? This is a case where it went higher. So you got this trade. This turned out great. That trade worked out, stopped out. You're looking for re-entry. Yeah, occasionally, Kim, you'll get some counter trend trades. Occasionally you will. We never used to do that too much, but you know, as we get these tools and we get more experience with these markets, it's possible to see and take some counter trend trades. It doesn't happen very often. I don't usually call. I don't think I ever call a counter trend trade in the room. I might take some, but I'm not going to call it out because I think a lot of people find those to be confusing. So if you're not comfortable with counter trend trades, then you simply have to identify what the trade is, and then you absolutely have to stick with it. Let's get crew down here real quick, and then we're going to run out of time. So any final questions? If you find this to be a little intimidating, don't feel bad about it. It takes a little while to learn it. It's not something you generally can pick up overnight, Takes a little bit of time to see these trades and learn how the system works. You got to be patient with yourself. Okay, let's look at a couple of crude trades here before we run out of time. Let's go look at the crude pit open today at 6 o'clock because I think there was some trades there. By the way, curious, how many of you trade crude oil on the team here tonight? How many of you trade crude oil? Quite a bit. Interesting. Charles D, Jim, Adam, Dave, good. Ron, Rick, Dennis likes the Nazi and the YM, okay. Peter, Kim, I like the cheaper contracts like Nazi for Kim, okay, good. All right, you ready? Here we go. Here's crude oil right at the pit open. I don't personally trade the pit open on crude oil. I've never had good luck with it, so I don't trade it. It's just not my cup of tea. It's not to say, it's not a comment on the instrument or the time itself. It's just I've never made money trading crude oil at the pit open. I generally like to wait a little bit, 6:30, 7 o'clock perhaps, into a little bit of the trading session, and then I look for crude to sort of settle down, and then I'll look, some days I don't even trade crude at all if it's choppy. So yeah, I mean, going into 6 o'clock, and I'm sure Gary had his lines on his charts. He always does. It looked like this. I mean, you were in a range. You had support down here. Oopsie, hold on. Yeah, at 6 o'clock going into the pre-market and the open of the crude session, you were in a range, a trading range, like this. Yeah, Jim, I'll show you something on that. Jim's concern is that he's concerned about trading and shorting oil now because it might be due for a substantial bounce at some point, and that's true. I'll show you a chart here shortly on oil as soon as I'm done showing this that might be starting to indicate that a bounce is going to occur. Yeah, so I don't know. I think he has like a 601 or a 602 Band-Aid. Is that what he puts in the room? Anybody remember? That's in there trading with him at the break. I can see right here just shortly after the pit open, you had a box forming right there. I'm sure he probably boxed that in, and you got a nice little long pop out of it, top of the trading range. Yeah, right in here. Did you get that long? Anybody remember? This pop right here. Yes. Okay, good. Thomas, the way you tell in real time is you need at least 3 points to know you're in a range. 2 can do it, but I prefer 3. For instance, in here you can see that you were pretty much in this range all pre-market session. So you had this swing here, you had these swings kind of here, you had this swing here. More or less, this range was kind of known going into 6 o'clock. You see the swings I'm talking about? Excuse me. Excuse me, hold on. Yeah, so you have to have some swings at your support levels. You simply take your line tool and put a line at the bottom. It's really literally that simple to help you see it and visualize what's going on. So here was support in the pre-market down here, right? And then at 5:38, so almost a half an hour before the crude pit open, you pretty much this swing had established itself. And so you want to, Thomas, as you're looking at doing this in real time, look for those swings. Say you're not in a live room and you're just looking at a chart. This is the way you do it. You put the line at the bottom and you put the line at the top. And the bottom line is this: as long as it stays within those lines, it is in a range. And all you need is the 2 or 3 points to do it. And then you do the extended horizontal line that goes out into the future. You can see here it came up, hit its head, rolled over, came back down, bounced back up. And you did if you weren't taking the bottom and covering at the bottom or buying support and shorting the top, or taking profits up there. You got a couple of mid-band boxes right here around 7 o'clock. We might have even taken these, or did we miss the long trades? We were so busy with making money on the equities, I don't remember the crude trades that we took. But yeah, so over here, of course, you can see going into about 7:30, crude takes out the top of the range here with this thrust move. And so when it does that, what are we looking for? When the top of the range is taken out with an upward thrust, what type of trades are we now starting to look for? Yeah, retracements to get long, right? Good. Here's an example of a shallow pullback. In this case here, we're pulling back off the swing at 31.35, but we're only coming back to what turned out to be almost kind of the top of that prior trading range right in there. And it's holding around just above 31.20. It's not getting down to the mid-band. It's not coming down to here, and then look what happens. Pops up through and continues on up. See it? Pops up through and then continues on up. Same with this retracement right here. Didn't quite get to the mid-band, did it? This is an example of a shallow retracement off that next thrust. So just a comment here. If you're going to trade crude, crude is notorious for this, where you'll get these thrust moves, and then it'll barely pull back, and then you'll get another pop up. And if your trading style is conducive to this, and you like this style, and you can see this, then by all means trade it. If you're not, if you're not attuned to this, and keep in mind, this is $10 a tick, so it's like the Russell. It's a little more pricey than the $5 instruments. Crude oil, when it's moving, it can make you a lot of money very quickly, and if you're on the wrong side of it, it can take away, give you some losses equally as quickly. And if you've traded crude, you know what I'm talking about. Let me show you something here, some bottoming action that is occurring on crude right now. And here's a chart that I look at. I haven't shown this in a while, but I'll show it right now. I look at this daily, by the way. Shallow retracements are where you're in a strong uptrend or downtrend, and the market only retraces a little bit. TSCL is a beast. And most of you know I'm extremely choosy on the crude oils that I take. I almost have to have a textbook perfect setup on crude for me to even consider it. If it doesn't meet my stringent criteria, like I love pulling back to the mid-band and sitting there with a nice little tight region box. That's my favorite trade. It's my go-to trade every day. Pretty much I got to see that on oil. If I don't see that, I don't even touch it. So here's crude over the past into last fall. You can see we're just in an incredible, strong, powerful downtrend. This is a 1440 minute. I look at these daily. It emulates the daily chart, but tries to eliminate the gaps in the futures deal here. So very clearly we are in a downtrending channel that pretty much looks something like this. The channel is looking like this. There's the upper part of the channel, right? Here's the lower part of the channel. Would look something like this, right? Now, you can see at several areas the market paused, and you can make the case that you got a slight short covering pause. I wouldn't even characterize it as a rally. It's just basically short covering, profit taking from upper levels. It occurred here at 42. Get a bip up to the upper part of the trading channel line here. You got a little bit of it at 36 right here. This would have been back in late December right here. And you got a little bit of a rally up to 38. Wouldn't really even call it a rally, just more or less like a little run up to the top of the part of the trading channel here. And so what's starting to happen at 30? These past couple of candles, what's happening right here, right now? Right here, these candles right here. This is the last 4 days. Starting to consolidate right at 30, isn't it? Let's blow this up and look in more detail at what's happening here. What has crude oil done the past 4 times when it got close to 30? Right here. What has it done? Right there. Find support. So what is that telling you? It's telling you that, at least for the moment, that there is some clear support at that level. Now, if you were to extend this out into the future, I don't know, I don't have a crystal ball, obviously nobody does, but you could probably make the case that if you extend this upward trend line down like such, and you had a similar pattern as this that you had in mid to late December, and a similar pattern that you had in mid to late November, here we are in mid to late going into January, it's quite possible we could see another pattern that might look something like this. We get some consolidation capitulation in this area right around 30, and then we might get a slight bump of some short covering in here, at least back up to the 33, 34 level, like this. It wouldn't surprise me at all if we get just a slight little follow drifting up into this area right here, and then this will be a critical juncture of where if she's going to roll over and head back down. And if it breaks it, when it gets to that scenario, I'd say around 32, 33, possibly 34, theoretically it should roll and continue its way back on down through 30. And you know what? Here's what we'll do. This will be kind of fun. I'll leave all these annotations on here. And when we come back next week, we'll look at what actually happens, and then we'll kind of plan around it. You want to do that? Get a 1440 chart up of your favorite instrument and do this. It really, I like looking at this. It might do something more. And then once it gets here, I'm going to say kind of anywhere in this 33, 34 area, right up in there. It might chop sideways in there for a while. You might get more candles that just kind of go sideways, and then you might get a little bit of a rally. Could come out of it and go that way. So we'll see. The next few days, the next week or two, going into the end of January, you know, of course, we got a lot of issues in the Middle East right now. Of course, we always do. But that always fuels. You get the whole Iran issue. You know, that is that their oil coming back on the market. You know, you've got all manner of problems. You get, you know, the Soviet Union, China, all sorts of things going on over there. Yeah, this would kind of be the crystal ball part of it. I mean, I think clearly there's the one takeaway is this, is that, you know, if you are short oil and it starts to get anywhere down around 30, you probably want to look to cover, at least for now, right? I mean, because there's clearly support down here right now. Okay. All right, let me stop the recording. Went a little bit over today. That's okay tonight. Thanks for sticking around, everybody.